Stocks losing earlier gains in a rocky beginning to the new year, though there is a recovery attempt underway in the last little while. But while it's an unsettled start, our next guest is now betting on a broad rally in some of last year's beaten down corners of the market. Ohsung Kwon is BofA Securities senior equity strategist. He joins me now, and it's great to have you on here. So big picture, you've got a formal S&P 500 target of 6666, exactly 6,000 points higher than the 2009 low, which would be a great year for the index, up 13% from here. But you think it might get there in a somewhat different fashion. Explain that.
Yeah, thanks for having me today. So our target of 6666, I think the way we get there is through the market broadening out, which we haven't seen yet. Last year was also a very narrow breadth market again for 2 straight years. I think, first of all, I think the macro cycle is still pretty favorable for equities. We are still in an easing cycle, although we might not get as many cuts as one might hope for. But fewer cuts because of a good economy. I don't think that's necessarily bearish for equities. I think that's actually bullish for stocks in general. And more importantly, earnings are accelerating. And also, we are expected to see more companies participating in that earnings growth. If you look at consensus numbers, 96% of companies are expected to post positive EPS growth by Q4 of this year. And I think the biggest reason why the market was so narrow over the past 2 years was because earnings growth was narrow. We couldn't really see any positive EPS growth outside the Max 7. The other 493 just came out of an earnings recession in Q2. So I think as the market, as earnings broaden out, I think so should the market, and I think that's going to be the name of the game in 2025.
Now, does that imply? I think you're sort of underweight tech, which has been the area of the market that's been driving the earnings story. You think the S&P can really do without technology's kind of big upside power and still get to that target of yours?
Yeah, it's not like we are bearish on tech per se. Mm-hmm. It's just that we think there's more juice to the upside in the other sectors. So the sectors that we like are more cyclically oriented sectors, such as financials, consumer discretionary, materials, real estate, and utilities is kind of like our hedge against things going wrong. And I think the biggest driver of that rotation, like I said, is going to be driven by earnings breadth broadening out. And I think the driver of that is going to be manufacturing cycle coming back. If you look at the manufacturing cycle, it's been in a downturn over the past 2 years. And the reason why that matters so much for equities is because half of earnings for the S&P 500 is tied to the manufacturing cycle. It's been the longest downturn in history for manufacturing. And as that manufacturing cycle comes back, because the destocking cycle is over, the election overhang is removed, and I think CapEx cycle is going to accelerate again. If that's the case, I think that's going to be a major boost for earnings for an average stock, and I think that's really going to be the driver of the market broadening out.
Yeah, it is fascinating that essentially the S&P's had 20% up years with manufacturing mostly on the downswing and, consumer confidence largely way below what you would expect. So clearly it's been an odd cycle in that respect. Do you think that, bond yields at any level might be a threat to the manufacturing story or just in general to the cyclical upswing?
Yeah, I think the current level of rates at around 4.5%, that's probably largely neutral to the manufacturing cycle. Manufacturing obviously is very sensitive to the rate environment. So if we were to see higher rates from here, that could potentially pose threat to that potential rebound in manufacturing. But at least in the near term, I think we are going to get that cyclical rebound in manufacturing, regardless of where rates are. I think tariffs are initially going to be positive because a lot of companies are going to pre-order, and they could potentially kickstart the restocking cycle that we haven't seen over the past 2 years. And I think the destocking cycle was one of the biggest reasons why we saw a manufacturing downturn over the past 2 years. Also, the election overhang being removed. If you listen to what retailers are saying in December, they're talking about how there was a lull in consumer spending before the election, and after the election, we saw a surge in consumer confidence and CapEx as well. So if that's the case, the election overhang being removed, I think that could potentially unleash both consumer spending as well as corporate spending going forward. And I think that's going to drive the cyclical rebound in manufacturing as well.